Good morning, options traders. Steve Gans here with a trade concept or idea that I'm going to share with you. So this is on Google. Google announces earnings tomorrow night. Today is January 29th. Google announces earnings after the close on January 30th. So this is an earnings-based trade, and the premise behind an earnings trade, generally speaking, with an options trader, is that volatility will drop significantly right after the earnings announcement. And as options traders, many times we may be trading the price movement of the underlying, but more often than not, for me, as what I would largely call a delta neutral trader, I'm trading the volatility or the change in volatility in a stock or the options for a stock. So let's just take a quick look at that and what I mean by that. So if we look at this particular trade, in this case, I'm looking at a calendar. This is an earnings calendar. And what that means is that I'm going to come in here and I'm going to, in this case, sell a call, and I'll be selling that call for $1.30. We can see that right here, $1.31, depending on what price I end up getting for it. And then I am looking at buying a call, and in this case, I'm looking to spend $3.15 for it. The difference between those, the difference between what I pay for this one and what I sell the other one for, is what my max risk is in this trade. You'll notice right now I have this modeled as being a February 2nd strike, which is this coming Friday. That's the one I'm selling short. So that one is going to have all of the extrinsic value go out of it by the end of the day on Friday. And then the one I'm buying right now, I'm looking at buying one all the way out on March 15th. Now, my premise behind that is that I can maybe, if this trade goes against me in some way, let's say that Google drops in value, I could potentially then sell additional short options against this long option, and I could maybe do that 1, 2, 3, 4, even as many as 5 times. And if I can pick up a couple of bucks or $1 or 50 cents each time I do that, I could potentially work a trade that goes bad on me back into a profitable trade. So when I do an earnings calendar, that is one of the things that I look at here, is I look at how might I split my short strike from my long strike. Now, let's also just take a look at, well, what if I just sold the next one out, the February 9th, for example? Well, that dramatically lowers my risk in this trade because I'm selling this one at $1.32. I'm buying this one at $1.62. Well, my max risk now is only 30 cents or $30. Obviously, in options, everything is times 100. So this is kind of a choice I can make. I can put this trade on here looking at the potential of only $30 in risk and having a gain that could be in the 100, 130 or so range if my thesis holds out. Or I could go further out in time on this long call and then consider potentially rolling short strikes along the way. So again, everything in options is a trade-off. It's like, do I want to have a way to manage this trade if it goes against me? Or am I okay basically knowing that this entire thing is essentially going to expire this Friday, and I really don't have a lot of management capabilities or time to manage this trade? Doesn't mean I can't manage it. It's just I'm going to have less potential time to manage it. So in my case, I'm going to look at doing this trade. Now, one thing that you can see in OptionStrat, which is really cool, is right now the combined volatility in these two options, let's look at them individually. The front strike right now has a volatility of 62%. We can see that right here. Our further dated option is only 41%. So if volatility is going to drop right after the earnings announcement, there's more potential drop that can occur when volatility is currently at 62% than if volatility were only at 41%. And let's just take a look at how that manifests itself. And this is pretty cool. In OptionStrat, we can do this. There's not any or many other programs that I'm aware of out there that has this capability. We can come right here and we can look at the volatility of these two options separately, and we can model them separately. So I can come into the February 2nd option. That's going to be the one that I'm expecting a sizable volatility drop in, and I can model that and see what happens if the volatility in that one drops and the other one stays about the same. Well, we can see that that puts a huge amount of potential profit into this trade very quickly. Again, overnight, that volatility will drop. The question is the front month going to drop significantly more than the back? I said month. The front period going to drop significantly more than the back period option. That's what we're looking to have happen. So I can reset this just by clicking my return there, and then it takes me back to the current volatility scenario on these. Again, I can look at these two and the variation between them. So why am I at the 160 mark? That's the next question that you might ask. I could have put this on right at where Google is currently trading. I could have come down here and said, you know what? I don't think this is going to move much one direction or the other, and I could put the trade on right here, and I have upside risk and I have downside risk. That's certainly a possibility. My premise, though, I'm pretty bullish Google. Google has broken out to new highs. Google, as you may know, owns YouTube. Google also has one of the better, disputably, the better AI engines out there called Bard. And so I just think that there's a pretty darn bright future for Google, and I think that in the earnings announcement that we're going to see some things said that are going to cause probably a jump up in Google. That's my personal expectation. So if that is my expectation, I would rather that my trade was centered up here somewhere, so that if it does, in fact, jump from its current 150 range up into the 160 range, I'm kind of centered in the sweet spot of where I would want to be on that trade. And again, this trade as it exists here, we're looking at approximately $30 in risk. Now, I will up this. Actually, I could have linked those legs. In fact, I should do that so that I'm keeping them equal. Okay, so I move this to a 10 lot, and again, this is a paper trade. If you haven't traded calendars, if you're not used to this sort of trading, please, please, please do a paper trade, okay? So, but I did it in a 10 lot, so it will be a little bit easier for people to see, digest the numbers, etc. So at this point, I'm going to go ahead and basically save this trade, and I will share it down below in the comments area. So I'm just going to call this, it's a calendar spread, but I'm going to add the word earnings in here because it is an earnings. I'm doing it specifically with the premise of earnings, and I'm also doing it with a bullish thesis, okay? So I'll go ahead and save that. I will share the link in the comments area down below, and please, of course, provide me with your thoughts, comments, ideas, questions as well. Love to get feedback on these. Take care, everyone.